Welcome to Lecture 1 of AJD Floating Bookkeeper's free video lecture series, the Tell-All About Bookkeeping. This lecture will provide an overview of the bookkeeping process. Bookkeeping is a handy tool for business owners who provide products and services to consumers in exchange for payment on a day-to-day basis. It's the process of documenting and recording financial transactions into their appropriate sales, purchase, or general journals. They are then posted to their appropriate accounts in the ledger as a debit on the left side or column of the account for an amount that is owing, or as a credit on the right for an amount that is gained. The accounts are then balanced according to their normal debit or credit balance. Asset, expense, loss, and owner's equity accounts have a normal debit balance, and revenue, liability, and owner's equity accounts have a normal credit balance. At the end of each month, the accounts with a non-zero balance are transferred to their appropriate columns in an unadjusted trial balance. The balances in the debit and credit column are then added up separately, and their sums will be equal to each other. Adjustments are then made so that the balance between the revenues and the expenses and the owner's withdrawals and owner's equity are accurately reflected. The balances of temporary accounts, such as accrued revenues, deferred expenses, and depreciation expenses, are transferred to permanent accounts. The adjustments are then recorded into the general journal and posted into the debit or credit column of the affected accounts, and the accounts are then balanced according to their normal debit or credit balance. All of the accounts that still have a non-zero balance are then transferred to their appropriate columns in an adjusted trial balance. The balances in the debit and credit column are added up separately, and then their sums are equal to each other. The financial information from the adjusted trial balance is then used to create clear and structured financial statements that are easy to comprehend and formally record the financial activities and position of a business at a specific period of time. The most common financial statements that are created for a business are an income or profit-loss statement, a balance sheet or statement of financial position, a cash flow statement, and a statement of changes in owner's equity. The income or profit-loss statement shows the revenues and expenses of a business over a period of time. The balance sheet or statement of financial position provides a summary of the financial balances of a business, listing its assets, liabilities, and owner's equity, and is created on a specific date. The cash flow statement is concerned with the cash that flows in and out of a business and provides a breakdown analysis of the operations, investing, and financing activities of a business. The statement of changes in owner's equity shows any changes that have been made to the retained earnings and equity of the owner or owners of the business. This wraps up Lecture 1 of our free video lecture series, The Tell-All About Bookkeeping. Stay tuned for the next video lecture in our series, What Are Accounts?, coming soon. Thank you for joining us. Please subscribe to our YouTube channel.